Hi, I'm Pattu from freefincal. Let's take a look at HDFC Nifty 500 Multicap 50 25 25 index fund. So this index, as the name suggests, will hold 50% of large cap stocks, that is among the Nifty 100, 25% of mid cap stocks among the Nifty 150, and 25% among the Nifty small cap 250 stocks. Typically, if you take the Nifty 500, which is market capitalization weighted, that will be large cap heavy. So typically about 70% will be large cap, about 15 to 20% will be mid caps, and only the rest would be small caps. And but this will have this kind of a bind kind of allocation. At first sight, it seems very nice thing to buy. You can think of it as a single fund to buy, and especially when the mid caps and small caps are doing well, people will get attracted to such funds. But let's take a look at the performance. So this is the Nifty 50 total returns index versus Nifty the multi-cap index, and you can see uh, for several durations here initially and thereafter, you can see that the multi-cap has not outperformed. So for several years it has not outperformed Nifty 50, and then there's an outperformance, then it falls down, then there's an outperformance. So the outperformance will be only periodic. So uh, after you put money in this fund, you must expect several years of underperformance or at least on par performance with Nifty 50. But if you take into account the higher tracking errors, because there are now 500 stocks to track and a lot more of mid caps and small caps, and if you take into account the higher fees and so on, the returns would be slightly poorer than the Nifty 50 during the periods of on par performance. And what's more interesting is that if you compare the Nifty Next 50 with the multi-cap, you can see that most of the time they are, they've been together. The two lines have been together except for occasional underperformance of the multi-cap and occasional outperformances. It has been together. So just by looking at this, it would tell you you don't need to buy this multi-cap. You can simply stay heavy in the Nifty 50 or the Sensex 30, the top 30. And if you want to scratch an itch of that FOMO, saying, oh, am I missing out, you can have a little bit of Nifty Next 50, and that's it. All your index or passive investing requirements are satisfied with just those two funds. You don't need any of these funds. So now these are the rolling returns over 5 years. The orange is the Nifty 50, the yellow is the multi-cap, and you can see over 5 years, you can see the yellow line stay close to the orange line, outperform, then go down, outperform and go down. So it will be cyclic. This will be over 5 years. Over 10 years, this is the data. Again, there's not much of a data. You can only see about 10-year period. The window itself is 10 years. The return is 10 year. Every data point here, there are like 2,340 data points in each colored line. That is, every data point is a 10-year return, but the window over which you are actually studying those 10-year data points is only 10 years. So it's very poor in terms of history. But even here you can see that there are periods where the yellow line falls down to the orange line and so on. There are some outperformances, but is it worth it? Is it worth, do you have to wait for some 10-year period that you have some chance of outperforming? There's no guarantee it will outperform. I don't think it's really worth it. Now, if you look at the volatility or the standard deviation, this is the rolling standard deviation over 10 years. The Nifty Next 50 is slightly more volatile than the multi-cap, and of course over Nifty 50. But you can see that the multi-cap is more or less typically as volatile as the Nifty 50, at least in the last few years. So, I mean, do you really need it? Absolutely not. You don't need it. You can just stay put with your Nifty 50 and Nifty Next 50. This is the standard line I'm going to say with all these new funds. But for what is the only benefit in these videos is this data. So that's all I have to say. Bye bye.